Right now, something is happening in the market that only occurs once every decade. And the last 3 times this happened, regular people with regular jobs turned a few $1,000s into life-changing wealth. I'm talking about teachers, nurses, truck drivers who became millionaires. And if you miss what I'm about to show you, you'll be kicking yourself for the next 10 years. Look, I know what you're thinking. Another video promising easy money. But here's the thing. I'm not selling you a course. I'm not asking you to buy anything. What I'm going to share with you is backed by decades of market data. And more importantly, by real stories of real people who saw the pattern and acted on it. By the end of this video, you'll understand exactly what's happening, why it matters, and what you can do about it starting today. So make sure to stay until the end, leave a like, and let's start. Let me paint you a picture. It's 2009. The world just went through one of the worst financial crashes in history. Everyone is terrified. Your neighbours are losing their homes. Companies are going bankrupt left and right. The news is telling you the economy is finished. And what do most people do? They panic. They pull their money out of everything. They hide it under the mattress. But there's a small group of people who did something different. They saw something nobody else was seeing. They looked at the fear, the panic, the chaos, and they saw opportunity. Not because they were lucky, not because they had insider information, but because they understood one simple truth about how markets work. Here's what they knew. When everyone is selling, prices drop to levels that make absolutely no sense. In 2009, you could buy shares of companies like Apple for around $12. Amazon was trading at about $85. Even the S&P 500 index, which tracks the biggest companies in America, dropped to around 670 points. These were companies that were still making products people wanted, still generating revenue, still employing thousands of people. The fundamentals hadn't changed overnight, but the prices had collapsed because fear took over. Now, fast forward to 2021, just 12 years later. That same Apple stock, over $150. Amazon, nearly $3,500. The S&P 500, above $4,700. People who invested $10,000 into the S&P 500 in March 2009 saw that money grow to over $70,000. That's a 600% return. Not from gambling, not from luck, just from buying when everyone else was selling. But here's where it gets interesting. This wasn't the first time this happened. Go back to March 2000. The dot-com bubble just burst. Technology stocks crashed. People said the internet was a fad. Tech companies were going bankrupt every single day. The Nasdaq fell from over 5,000 points to below 1,200. That's a drop of over 75%. Companies like Amazon, which was already a major retailer, dropped from $85 a share to just $6. Cisco, the networking giant, fell from $80 to $10. Everyone said tech was dead, that the whole internet thing was overrated, that we'd gone back to the old economy. But anyone who bought at the bottom in 2002, they watched that money multiply 6 times over by 2007. And if they held through the 2009 crash and kept holding, they made even more. Those Amazon shares that dropped to $6, they're worth over $3,000 today. That's a 50,000% gain for anyone patient enough to hold. And we can go even further back. In 1987, the market crashed 22% in a single day. Black Monday, they called it. It was October 19th. People woke up, turned on the news, and watched their retirement accounts get destroyed in real time. Trading floors were in chaos. Brokers were literally crying at their desks. People were convinced it was the end of capitalism, the beginning of another Great Depression. But within 2 years, the market fully recovered. Within 5 years, it had doubled. The people who bought during that crash, or even just held their existing investments instead of panic selling, made fortunes. And this pattern goes back even further. The 1973 to 1974 crash, the 1929 crash, and Great Depression recovery. Every single time, the story is the same. Panic, fear, massive sell-off, then recovery, then new all-time highs. So what's the pattern here? What's the common thread? It's simple. Every decade or so, the market goes through a massive correction. Fear takes over. Prices drop way below what they should be. And the people who understand this, who keep their emotions in check, who buy when everyone else is running away, Those are the people who build serious wealth. This isn't theory. This is documented history repeated over and over for the past 100 years. Now you might be asking yourself, why does this keep happening? Why do markets crash and then come roaring back? The answer is human psychology. Markets are driven by two powerful emotions, fear and greed. When things are good, greed takes over. People buy because they don't want to miss out. Prices go up and up until they're way too high. Then something happens. A crisis, a crash, a recession, and fear takes over. Everyone sells, prices collapse. But here's the key. The actual value of good companies doesn't disappear overnight. Think about it. When Apple's stock dropped to $12 in 2009, did the iPhone suddenly become worthless? No. People were still buying iPhones. The company was still making billions in revenue. It was just that fear had driven the stock price way below what the company was actually worth. Same with Amazon. People didn't stop shopping online during the financial crisis. In fact, they probably shopped online even more because they were trying to save money. But the stock price collapsed anyway, because everyone was panicking. This is what Warren Buffett means when he says, "Be fearful when others are greedy, and greedy when others are fearful." It's not just a catchy quote. It's a proven strategy that has created more millionaires than any other investment approach in history. Buffett himself made billions following this exact principle. He bought stocks during the 2008 crisis when everyone else was selling. He invested in American Express during a scandal in the 1960s. He bought Coca-Cola after the 1987 crash. The pattern is always the same. But let me show you some real examples of regular people who used this strategy. In 2009, a teacher in Ohio named Veronica was 32 years old. She had about $15,000 saved up. When the market crashed, everyone told her to wait. "Don't invest now," they said. "It's too risky. The market could drop another 50%. You'll lose everything." But Veronica did her research. She read about past crashes. She understood the pattern. She knew that historically, major crashes were followed by major recoveries. So she put that $15,000 into a simple S&P 500 index fund. Not individual stocks, not options or crypto or anything fancy. Just a boring index fund that tracked the 500 biggest companies in America. By 2020, that investment was worth over $90,000. She didn't try to time the market. She didn't day trade. She didn't check her account every day. She just bought and held. And now she's on track to retire early because of that one decision she made when she was 32. Or take Alex, a construction worker from Texas. In 2008, he was 45 years old and had $25,000 in his retirement account. When everything crashed in 2009, he did something that seemed crazy at the time. He borrowed $10,000 from his home equity line and added it to his investment. His friends thought he lost his mind, taking on debt to invest during a crash? That's insane. But Alex understood something they didn't. The math was on his side. He knew he could pay off that home equity line in a couple years from his construction income. And he knew that historically the stock market had never stayed down for more than a few years after a major crash, so he took that calculated risk. By 2015, that $35,000 he'd invested had grown to over $110,000. By 2021, it was worth more than $250,000. Alex retired at 58, 7 years earlier than he'd planned. Because of that one decision, he's now living in a paid-off house on a lake, fishing every day, while his friends who called him crazy are still working construction. Let me give you one more example that really drives this home. During the 2020 COVID crash, the market dropped 34% in just 23 days. It was the fastest crash in history. People were terrified. The world was shutting down. Nobody knew what was going to happen. Airlines were grounded, restaurants were closed. The unemployment rate shot up to levels not seen since the Great Depression. The news was nothing but doom and gloom. Experts were predicting the market would drop another 50%. Some were saying it would take a decade to recover. But again, some people saw the opportunity. A nurse in California named Jessica had been saving money for years. She had about $40,000 in her savings account, earning basically nothing in interest. When the market crashed in March 2020, she made a decision that her family thought was insane. She took $30,000 of that money and invested it. Not in individual stocks, She wasn't trying to pick the next Tesla or Amazon. She just bought broad index funds. VOO, which tracks the S&P 500. VTI, which tracks the total US stock market. She split it between those two. Her parents told her she was crazy. Her friends said she was throwing her money away. The news kept saying the market would drop another 50%. But Jessica understood the pattern. She'd studied what happened in 2009. She'd read about the dot-com crash. She knew that when everyone is panicking, that's usually the best time to buy. And she was right. By the end of 2020, that $30,000 had grown to almost $50,000. By early 2022, it was worth over $65,000. That's more than double her money in less than 2 years. And she didn't do anything complicated. She just bought and held. Now I want to address something important here. Some of you might be thinking, sure, it's easy to say this now. Looking back, of course, investing in 2009 or 2020 was a good idea. But when you're in the moment, when everyone around you is freaking out, when you're watching your account balance drop every single day, it doesn't feel that simple. And you're absolutely right. It's not easy. If it was easy, everyone would do it. The reason most people don't build wealth this way isn't because they don't know about it. It's because they can't control their emotions when it matters most. They know they should buy low and sell high. But when the time comes to actually buy low, when everyone is panicking and the news is terrible and their portfolio is down 40%, they freeze up. Or worse, they sell at the bottom and lock in their losses. This is why having a plan before the crash happens is so important. You need to decide, right now while things are relatively calm, what you'll do when the next big crash comes. Because it will come. Maybe it's this year. Maybe it's next year. Maybe it's 5 years from now. But it will happen. And when it does, you need to be mentally prepared. You need to have cash ready. You need to know exactly what you're going to buy. And you need to have the discipline to execute that plan, even when your gut is telling you to run. Just for you to know, I opened a free community where I share tips on how to make your YouTube channel from zero in 2026. And trust me, YouTube has made a lot of regular people rich every year. So join with the link below. Now here's what makes this even more powerful. You don't need to be a genius to do this. You don't need a finance degree from Harvard. You don't need to understand complicated charts or technical analysis or read earnings reports. All you need to understand is this basic principle. When great companies go on sale because of fear, you're buying opportunity. When the S&P 500 drops 30% or 40% and everyone is running for the exits, that's when you should be running toward the entrance. Let me break down the actual numbers for you because this is important. From 1950 to today, the stock market has had a major correction. We're talking 20% or more, about once every 10 years on average. And every single time, without exception, the market has recovered and gone on to hit new highs. The average time to recover? About 2 to 3 years. But here's the crazy part. The average return in the 10 years following a major crash. Over 200%. That means if you invest $50,000 right after a major crash and hold for 10 years, you're looking at potentially $150,000 or more. But here's where most people mess up. They wait too long. They want to see the recovery happening before they invest. They want confirmation that things are getting better. By the time they feel comfortable, by the time the news is positive again, by the time their friends are talking about their stock gains, prices have already gone back up. They miss the opportunity. They end up buying near the top instead of near the bottom. This is why timing matters. Not in the day trading sense where you're trying to buy at the exact bottom and sell at the exact top. That's impossible. Nobody can do that consistently. But in the sense of recognizing when fear has pushed prices below their true value, when solid companies with real profits and real products are trading like they're going bankrupt, when the S&P 500, which represents the entire American economy, is down 30% or 40%, even though America isn't actually ending. So how do you know when that moment arrives? There are a few clear signs. First, you'll see extreme pessimism in the news, not just bad news. Extreme doom and gloom. Headlines about the end of the economy. Experts predicting another Great Depression. Talk about how this time is different and will never recover. Second, you'll see major indexes down 30%, 40%, sometimes even 50% from their peaks. Not 10% or 15%. Those are normal corrections that happen all the time. I'm talking about real crashes. the kind that make headlines around the world, the kind that cause CNBC to have special coverage all day. Third, and this is important, you'll see fear in your own gut. That feeling that says, maybe I should just stay in cash, maybe this time really is different, maybe the market won't recover this time. That fear, that sick feeling in your stomach when you think about investing, that's actually your signal that it's time to start looking for opportunities. Because when you feel comfortable investing, when it feels safe, that's usually when you're late to the party. But let's talk about risk for a second, because I know that's on your mind. Yes, investing when the market is down carries risk. Companies can fail. Markets can stay down longer than you expect. The economy might not recover as quickly as it did in the past. This is all true. This is why you need to follow a few critical rules. Number 1, only invest money you won't need for at least 5 years, preferably 10. This isn't money for next month's rent or next year's vacation. This is long-term money. Money you can afford to leave alone and let compound. If you might need the money in the next year or two, keep it in cash. Don't invest it. Number 2, focus on diversified investments like index funds rather than individual stocks unless you really know what you're doing. When you buy an S&P 500 index fund, you're not betting on one company. You're betting on the entire American economy. And over the long term, the American economy has always grown, even after crashes, even after recessions, even after wars. The trend over decades is always up. Number 3, never invest borrowed money unless you fully understand the risks and have a solid plan to pay it back. Alex from the earlier example. He borrowed money, yes, but he had a stable construction job. He knew exactly how he'd pay it back. He wasn't gambling, he was taking a calculated risk. If you can't explain to yourself how you'll pay back the loan, even if your investment drops 50%, don't borrow money to invest. Alright, so here's why I'm making this video right now. As I'm recording this in early 2026, we're seeing some interesting patterns emerge. We've had significant volatility over the past couple of years. Certain sectors have pulled back substantially from their highs. Interest rates have been high for an extended period. Inflation has been a persistent concern. Consumer confidence is shaky. Economic growth has been slowing. Now, I'm not saying we're at the exact bottom right now. Nobody can predict that. What I am saying is that we're in a period where fear is starting to creep into the market, where valuations in many sectors are becoming more reasonable, where the risk-reward ratio is starting to shift in favour of long-term investors, where people who have been waiting on the sidelines with cash might want to start paying very close attention. Look at what happened with technology stocks over the past year or two. Companies that were trading at insane multiples in 2021, where investors were paying 50 or 100 times earnings, have come back down to earth. The Nasdaq had a significant correction. Many growth stocks are down 50%, 60%, even 70% from their peaks. Some of these companies are garbage. They were overvalued at the top, and they're still overvalued now. But some of them have real businesses, real revenue, real profits, real potential. They just got caught up in the hype, and now they're being punished by the fear. This is exactly the kind of environment where wealth is created. Not by the people who buy at the top, when everyone is excited and prices are sky high. Not by the people who panic at the bottom and sell everything. But by the people who do the opposite, who study the fundamentals, who understand that great companies on sale are rare opportunities, who have the patience and discipline to invest for the long term, who can look past the fear and see the value. Here's something most people don't realise. The biggest gains in the stock market don't come during the good times when everything feels safe. They come in the recovery phase after a crash. From March 2009 to March 2010, just 1 year, the S&P 500 gained 68%. From the 2020 COVID crash bottom in March to the end of that year, less than 9 months, the market was up over 65%. These explosive moves happen when fear turns to optimism, when people realise the world isn't ending, when money on the sidelines starts flowing back in. But you can't participate in those gains if you're sitting in cash waiting for the perfect moment. Because by the time everything feels safe, by the time your friends are talking about their stock gains again, by the time CNBC is bullish and the headlines are positive, that explosive recovery period is over. You'll be buying at higher prices, getting lower returns, wondering why you didn't act sooner. So what should you do? Let me give you a practical approach. If you have money to invest, don't put it all in at once. Use a strategy called dollar cost averaging. Take your total amount and divide it into chunks. Maybe you invest 20% of it now, then 20% more in a month, then 20% more the month after that. Keep doing this over 6 months or a year. This way, if the market goes down more, you're buying at even better prices with your later investments. If it goes up, you still got some money in early and you're participating in the gains. Focus on quality. Look for companies or funds that have survived multiple economic cycles. The S&P 500 has been around for decades and includes the strongest companies in America. Total market index funds give you exposure to thousands of companies at once, spreading your risk. These aren't sexy picks. They won't make you rich overnight. Nobody is going to be impressed when you tell them you bought a boring index fund. But they're the investments that have consistently created wealth over time. They're what made Veronica and Alex and Jessica financially independent. And here's another thing. Don't try to be a hero. Don't think you need to pick the next Apple or Amazon. Most professional investors can't do that. Most actively managed mutual funds underperform the S&P 500 over 10 years. If the experts with teams of analysts and billions of dollars can't consistently pick winners, what makes you think you can? Instead, buy everything. Buy the whole market through an index fund. That way you don't need to pick winners. You just need the market to do what it's always done, which is go up over time. Here's the bottom line. Every generation gets a few moments like this. Moments where the market offers up incredible opportunities because fear has taken over. Moments where regular people can build extraordinary wealth just by staying calm and thinking long term. These moments don't come around often, maybe 3 or 4 times in your entire investing career, but when they do come, they can change your life if you're prepared to act. In 2009, people who had the courage to invest when everyone else was panicking changed their lives. A $10,000 investment in the S&P 500 at the March 2009 bottom would be worth over $80,000 today. That's enough to change someone's retirement. That's enough to pay for a kid's college education. That's enough to buy financial freedom. And the crazy thing is, it didn't require any special skill, just the willingness to go against the crowd. The same opportunity existed after the dot-com crash in 2002, after the 1987 crash, after the 1973 to 1974 crash, after every major market correction in history, and it will exist again in the future. The question is, will you recognize it when it comes? Will you have the discipline to act? Or will you let fear keep you on the sidelines? Remember, wealth isn't built by following the crowd. The crowd buys at the top when prices are high and everything feels safe. The crowd sells at the bottom when prices are low and everything feels scary. The crowd gets it backwards every single time. Wealth is built by understanding cycles, by recognizing when emotions have pushed prices away from reality, by having a plan and sticking to it even when it feels uncomfortable. I want to be very clear about something. I'm not telling you to invest your rent money. I'm not telling you to quit your job and day trade. I'm not telling you to go all in on risky penny stocks. I'm not promising you'll get rich quick. What I am saying is this: if you have money set aside for long-term investing, if you understand that markets go through cycles, if you can handle the volatility and stay patient, then periods of fear and uncertainty are when you should be paying attention, not running away. The teacher who invested $15,000 in 2009 didn't have special knowledge. She didn't have insider information. She just looked at the data, saw the pattern, and had the courage to act. The construction worker who borrowed $10,000 to invest during the crash wasn't a professional trader. He just understood basic math and probability. The nurse who invested during COVID wasn't lucky. She was prepared. She'd been saving money specifically for this kind of opportunity. These are normal people. They have normal jobs. They're not geniuses. They're not rich. They just understood one simple truth. When good companies go on sale because of fear, you buy them. Then you wait. You ignore the noise. You turn off CNBC. You stop checking your account every day. You stay focused on the long term. And eventually, over years, the market rewards that patience. It always has, every single time, throughout history. 10 years from now, people will look back at this period and say, that was the time to invest, just like they say about 2009. just like they say about 2002, just like they say about 1987, just like they'll say about every market correction for the rest of time. The only question is, will you be one of the people who took advantage of it? Or will you be one of the people who watched from the sidelines and wished they had acted? History doesn't repeat exactly, but it sure does rhyme. The pattern is clear, the opportunity is real, the data backs it up. The question is, what are you going to do about it? Are you going to let fear control you like it controls most people? Or are you going to use fear as your signal to start looking for opportunities? The choice is yours, but remember this, the next time the market crashes, and it will crash, the people who profit won't be the ones who are surprised. They'll be the ones who were expecting it, who were prepared for it, who had a plan and executed it. Will that be you? If this changed how you think about investing, hit subscribe. Oh, anyway, I opened a new completely free community where I explain how to create and scale your YouTube channel. After an experience with over 10 successful channels, there I will give you all my strategies and tips to monetize and scale your faceless YouTube channel, and I will help you step by step. Since YouTube is the golden opportunity of 2026 if done well, I'm waiting for you. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.